In our previous discussion, we unpacked the complexities surrounding Hyperscale Data Inc. Today, we shift our focus to Momentus Inc., ticker MNTS, a company deeply embedded in, well, the burgeoning field of in-space infrastructure services. Our central question for this discussion is this. Given Momentus Inc.'s significant operational activity and strategic contracts in this rapidly evolving space industry, can the company successfully navigate its severe financial challenges and achieve sustainable growth? Now, my perspective is that the company's numerous contracts and technological advancements signal a promising future, despite what the current financial metrics might suggest.
And my view, which I think comes at this from a, let's say, a more grounded angle, is that Momentus Inc.'s persistent poor financial performance and its, frankly, reliance on heavily dilutive financing raise some very serious concerns about its long-term viability. Challenges that, in my opinion, cannot simply be brushed aside by the promise of, future potential.
Momentus Inc. truly stands, I think, at the forefront of what we're now widely referring to as the new space economy. This isn't just about launching rockets anymore. It's fundamentally about making space more accessible, more operational, and ultimately more commercially viable for both government and private entities. Momentus is delivering essential in-space infrastructure services, including space transportation for deploying satellites, offering satellite as a service to manage orbital assets, and providing crucial in-orbit servicing capabilities. These are all vital functions for the burgeoning satellite industry, and indeed for future deep space missions. What's more, the company holds a key patent for spacecraft propulsion devices and systems with microwave excitation, which suggests a foundational technological innovation that could genuinely differentiate them in this highly competitive, high-stakes sector. The consistent news flow surrounding Momentus, in my view, is pretty compelling evidence of robust operational progress and strong market validation. Consider just a few examples. In August 2025, they secured a significant NASA contract to study robotic technologies for future space exploration, with reports indicating their stock actually, soared on this news. Briefly, perhaps, but it shows market reaction. Just prior to that, in July 2025, they received milestone payments for a successful DARPA contract and partnered with Orbit Fab, a key player in space servicing and refueling. Looking back to April 2025, they signed a substantial 5-year master service agreement valued at $15 million with Velo 3D, a leader in 3D printing. These aren't isolated events. Momentus has repeatedly secured contracts with prestigious entities like NASA, DARPA, and the U.S. Space Force, and collaborated with commercial giants like SpaceX. These achievements are more than just headlines. They highlight the deep and credible partnerships the company is forging. These partnerships are absolutely crucial for establishing a firm foothold and gaining market share in what is, let's be frank, an extremely capital-intensive yet high-growth sector. The successful deployment of payloads from its Vigoride 6 mission back in July 2023 further solidifies their operational capability. I understand the inclination to scrutinize the financials, but these operational successes, in my mind, are strategically laying the groundwork for future growth.
I fully appreciate the vision of the new space economy, and yes, the technological promise Momentus Inc. embodies. However, I find it difficult to reconcile that vision with the company's current financial reality. While operational wins are indeed important, I simply don't believe they sufficiently de-risk what I see as an increasingly precarious financial situation. A closer look at their financial health reveals a deeply concerning picture. The company's sales, for instance, stand at a mere $0.91 million, a mere $9,100,000. Yet, it reported a staggering income of negative $32.24 million, indicating a profound and, quite frankly, unsustainable operational burn rate. This translates directly to an EPS, or earnings per share, of negative 13.40 and a deeply negative book per share of negative 1.71. Furthermore, Momentus Inc. exhibits alarming liquidity issues. Both its quick ratio and current ratio, which are key indicators of a company's ability to meet its short-term obligations, are a meager 0.22. This means the 80 possess roughly 22 cents in liquid assets for every dollar of immediate liabilities, suggesting a significant struggle to meet short-term obligations, a fundamental existential threat to any ongoing operation. Profitability metrics are equally dire. A gross margin of negative 92.60%, an operating margin of negative 2930.50%. I mean, these numbers are astronomical. And a profit margin of negative 3562.32%. These figures demonstrate equivocally that the company is effectively selling its services far, far below cost, leading to massive and compounding losses. The market's perception unfortunately reflects this grim reality, with the stock price plummeting 84.87% year to date, negative 89.20% over the last year, negative 99.90% over 3 years, and an astonishing 99.98% over 5 years since its January 2020 IPO. Such consistent and extreme value destruction, coupled with multiple NASDAQ deficiency notifications for delayed filings in 2024 and a delisting determination notice back in September 2024, points to severe underlying issues that, in my estimation, go well beyond typical early-stage growing pains.
Those financial figures are certainly stark, I grant you that. But I believe we need to frame them differently when we consider the inherent challenges of this specific industry. The consistent influx of contracts, particularly from government agencies like NASA and DARPA, should be viewed as a strong indicator of a burgeoning revenue pipeline. The $15 million 5-year agreement with Velo3D, for example, isn't speculative. It's a tangible commitment for significant future revenue. In a highly specialized, capital-intensive industry like in-space infrastructure, which requires massive upfront investments in R&D, specialized hardware, launch infrastructure, you name it, early-stage companies often incur substantial losses. They are aggressively investing in building out their core capabilities in infrastructure for future scale. The negative margins and currently low revenue, while undeniable, are, in this context, quite understandable, I think. The company is in an investment phase, building the foundation for what they hope will be larger-scale, profitable operations down the line. I contend that the issue here isn't lack of market demand or unvalidated technology, but rather the timing of revenue recognition and the inherent scaling challenges of such a cutting-edge industry. We even saw that the recent NASA contract win in August 2025 led to the stock soaring, demonstrating that the market, at least momentarily, recognized these fundamental business developments and future potential. This initial cash burn is often characteristic of industries where first-mover advantage and long-term infrastructure build-out are paramount. Companies like Amazon, in its early days, for instance, famously prioritized market share and infrastructure over immediate profit, a model we might be seeing here in a highly specialized context.
I understand the parallel you draw, but where I diverge is on the immediate financial implications and, well, the trajectory. While a pipeline of contracts is undeniably important, the critical question, in my view, is whether these contracts can actually translate into profitable revenue before the company completely runs out of capital. Momentus Inc.'s reported sales figures are not merely low. They show a deeply concerning trend. Sales year over year on a trailing 12-month basis decreased by 70.65%, and sales quarter over quarter dropped by 84.20%. That's not growth. That's contraction. This suggests that despite new contract wins, the company is struggling significantly to maintain or grow its top line. This implies existing contracts may not be sufficient in volume, or more alarmingly, are not being executed profitably enough to offset expenses. The massive losses we've discussed, that $32.24 million against the minuscule $0.91 million in current sales, highlights a profound disconnect between their operational activity and their financial outcomes. And frankly, those severe liquidity ratios of 0.22 are particularly alarming. A company that cannot even cover its immediate liabilities faces a fundamental existential threat to its continued operations, regardless of its long-term vision or impressive contract pipeline. A vision doesn't pay the bills. And while early investment is crucial, the line between strategic burn and unsustainable burn is perilously thin here. Historically, many ventures in capital-intensive sectors have failed precisely because they couldn't bridge the gap between impressive technology and profitable scale, becoming in essence zombie companies reliant on continuous dilution. How do you account for that industry context when the top line revenue is actually shrinking year over year? That seems counter to the growth narrative.
That's a fair challenge regarding the shrinking top line, and it certainly highlights the immense pressure they're under. However, my argument is that the ability to consistently secure these highly competitive contracts, especially from discerning and risk-averse entities like NASA and DARPA, fundamentally validates the underlying technology and the company's strategic direction. This brings us directly to the critical role of capital raises and whether they're a necessity for growth, as I believe, or a symptom of deeper problems leading to shareholder dilution, as you suggest. The numerous capital-raising activities, including at-the-market offerings, which allow a company to gradually sell new shares into the market, registered direct offerings, which are direct sales of securities to specific investors, and warrant inducement transactions, where warrants are offered to incentivize investors, are, in my view, essential mechanisms for a pioneering company like Momentus to finance its ambitious projects. They need this capital to fund the research and development for their patented propulsion technology and to fulfill their growing list of government and commercial contracts. The very fact that they can consistently raise capital, even after previous reverse stock splits and NASDAQ warnings, signifies a continued belief from a segment of investors in the company's long-term potential. These investors evidently see Momentus playing a critical role in the future space economy. These aren't just desperate attempts to stay afloat. These are strategic financial maneuvers designed to ensure the company has the necessary resources to scale its operations and bring its innovative services to fruition. The market is evolving rapidly, and companies need significant capital to maintain a competitive edge and build the necessary infrastructure.
Strategic financial maneuvers is certainly one way to put it. Another way is a pattern that paints a picture of a company in a perpetual state of financial distress. We're talking about multiple at-the-market offerings like 2.7 million, 4 million, 5 million, alongside registered direct offerings of similar magnitudes and various warrant inducement transactions. This isn't an occasional infusion for expansion. This looks like a constant scramble for cash. This pattern is further compounded by repeated reverse stock splits in December 2024 and August 2023. A reverse stock split, as you know, is a corporate action where a company reduces the total number of its outstanding shares, often to boost its stock price per share, simply to maintain listing compliance.
A necessary evil sometimes.
Perhaps, but they are typically a last resort and often result in significant value destruction for existing shareholders without addressing the underlying business model flaws. The NASDAQ delisting notices for delayed filings and a prior delisting determination in September 2024 further underscore serious governance and financial reporting challenges, which also heavily impact investor confidence. What's more, the market's high short interest of 16.6%, where a significant portion of shares are borrowed and sold by investors betting the price will fall, and a very low short ratio of 0.26, which indicates how quickly those short positions could theoretically be covered, collectively signals significant skepticism from professional investors. They are quite literally betting against the stock's future, which suggests a deep lack of confidence in the company's financial trajectory, despite the reported operational wins. While some investment is necessary, at what point does the constant dilution become financially irresponsible to shareholders if the company cannot demonstrate a clear path to generating profit or even just stemming the losses?
I concede that the current financial metrics are indeed very challenging, and the scale of losses and dilution is undeniable. However, we must consider these in the context of a longer-term horizon, which brings us to the interplay between analyst sentiment, the company's long-term vision, and its current reality. The very existence of Momentus Inc.'s patented spacecraft propulsion devices and systems with microwave excitation, and its core business description as a provider of space transportation, satellite as a service, and in-orbit servicing, fundamentally showcases its long-term vision and potential to capture a vital, growing segment of the space economy. Looking at the analyst recom from FinViz, it shows a strong 1.00 rating, indicating a strong buy, essentially. And the target price is listed at an astonishing $57.40.
$57 compared to $1.20 currently? That seems optimistic.
It is optimistic, but it reflects potential. While it's true that one analyst, Evercore ISI, rated it underperform with a $2 target back in July 2022, Deutsche Bank initiated with a buy and a $10 target in January 2022. This mixed analyst landscape, particularly the FinViz aggregation, points towards a belief, at least among some, in the transformative potential of the company's offerings and the sector it operates in. For a disruptive technology company, the focus fundamentally should be on this long-term high-growth potential and the strategic value validated by its contracts with leading space agencies and commercial partners. It's about looking past the immediate financials to the larger picture of what they are building and what that future market could be worth.
While the ambition and the target market are undoubtedly significant, I find it difficult to align that optimism with Momentus Inc.'s current financial reality, even stretching out to a long-term perspective. A 1.0 analyst recommendation and a $57.40 target price when the stock is currently trading at $1.20 and has declined by nearly 92% from its 52-week high, appears profoundly disconnected from the company's severe fundamental issues. The negative margins, negative book value, and persistent cash burn that we've discussed repeatedly demonstrate that the company has not yet found a viable path to profitability or even self-sustainability from its core operations. The market capitalization of just $13.96 million and an enterprise value of $19.11 million are remarkably low for a publicly traded company, especially one that requires such vast capital injections to fund its operations.
Enterprise value, for clarity, includes not just market cap, but also debt, minority interests, and preferred shares, minus cash, making it a more comprehensive measure of a company's total value. The vast gap between an aspirational future and the current acute financial distress is simply too wide to bridge without a fundamental shift in operational efficiency or a massive, non-dilutive infusion of capital, neither of which is evident in the material we have reviewed. The question becomes, how long can a company operate on vision and analyst targets when the cash burn is so aggressive and the share price continually eroded for existing investors? It feels like hope is outweighing the hard data here.
Momentus Inc. is undeniably operating in a pioneering, high-potential industry that is absolutely critical for the future of space exploration and commercialization. The ongoing stream of strategic contracts and partnerships with major government agencies and reputable commercial entities should be seen as strong validation of its technology and its long-term market position. While the financial challenges are apparent, I maintain they're indicative of a growth stage company in a capital-intensive sector, laying the groundwork for future, potentially substantial revenue and profitability. The path forward may indeed be arduous, very arduous perhaps, but the foundational achievements and technological innovations suggest that this is a company with real potential to redefine how we operate in space.
And while that vision for in-space infrastructure is certainly compelling, Momentus Inc.'s current financial state presents undeniable and, I would say, acute red flags that cannot be ignored. The persistent, massive losses, rapidly declining sales, severe liquidity issues, and a continuous reliance on dilutive capital raises, all while facing NASDAQ compliance challenges, suggest a business model that is not yet viable or, frankly, sustainable in its current path. The operational achievements, however impressive on paper, have not translated into sustainable financial performance, posing a significant risk to its long-term survival. For any investor, one must critically weigh the speculative long-term promise against the immediate and severe financial distress staring them in the face.
Both perspectives certainly highlight the complex nature of evaluating companies in these nascent high-tech industries. It's a classic tension between groundbreaking innovation and the often unforgiving realities of financial performance.